Hi there, I'm Christina Mackay, and today I just want to touch on the types of financing for your startup or small business. I just want to look at debt and equity and just explain a bit about the different players in the market that can help finance your business and what some of the pros and cons are. So just really simply and at a high level, when we talk about debt, think about a bank loan. So they will loan you some money, there will be a contract, you will do regular repayments on this money, and you'll pay interest. And so that's really the basics of debt financing. And then equity means that somebody will invest in your business, and in return they will have a stake in your business, they'll have ownership of the business. So example, they might give you £10,000 investment, you might give them 10% of your business, so they have ownership. So now let's talk about some of the pros and cons of those. Well, essentially they'll be the converse of each other. So let's just talk about equity to start with. Some of the pros of equity are that you get some smart money because you should do, because you should be bringing in high net worth or sophisticated investors that know what they're doing, or VCs that know what they're doing. So you get that smart money, which is great. Another benefit of equity is that there aren't these regular repayments, and nobody can suddenly whip out their money. They can't say on demand, I want my money back. They can't do that. So that just makes it a bit more secure for you to be able to use the money to grow your business. And also you can get some equity finance when you're pre-revenue. So I think this is really important for earlier stage startups. If you really can't launch your product before you get some funding, then equity is a better option for you. So those are some of the pros. In terms of some of the cons, some of the disadvantages with equity is that you do, of course, lose a bit of ownership. So it's dilution of ownership. With this one, I do try to tell people not to worry about that too much, because it's so much better to have 20% of your business that's become a £100 million company than to have 100% of your business that hasn't got off the ground. So don't worry too much about ownership, but just do bear that in mind. And that, I think, does influence you further down the line when perhaps you're in Series A, Series B, certainly Series C, when you might turn from equity financing to debt financing so that you don't continue to lose ownership of your company. But early on, I would recommend that you do get other people involved and give up a piece of the pie for that. In terms of some of the other disadvantages of equity financing is that it does take longer than debt financing usually. A lot of due diligence is involved, which is a good thing. Due diligence is very important. You can speed up the process of due diligence by really being prepared for that funding round. So preparing all your documentation, your business plan, your pitch document, your financials, but really going into the detail, really thinking it through and having explanations for all your assumptions and sort of details on where you've got all the financial figures from, your forecast from. So it does take longer, but you can speed that up. The final thing in terms of disadvantages of equity is that some people call it expensive money. It's the most expensive money to get because of this losing ownership of your company. But again, if there's no other choice and that helps you launch your business and grow to be a fantastic company, then I wouldn't worry too much about that. So that's debt and that's equity. So now I just want to talk about some of the players in the market. So I'm going to start with focusing on equity and talk about some venture capitals and some angels. So firstly, what are venture capitals and what are angels, and what's the difference between them? Well, essentially, angels are high net worth or sophisticated investors. They're people who have invested in companies and startups and small businesses over a period of time. They usually have a portfolio of companies. This portfolio is usually diverse, and that could be diverse in terms of industry or stage of the company. So some of them might be revenue generating and some of them pre-revenue. And they are people who often they will have been entrepreneurs themselves and have exited a company and therefore using that money to now invest in new companies. So those are angels. And then venture capital firms, these are essentially a management firm of a fund. So they seek investment and they as for their fund, and they might seek this from private investors, but a lot of institutional investors. And then they will invest their fund money to provide that return on return on investment for their investors, for their clients. So VCs are bigger than angels, and VCs will often come into the funding process slightly later down the line than angels because they're bigger. So just thinking about some of the pros and cons of angels and VCs. Well, some of them cross over, some of them are the same. So let's start about some of the benefits. And same for both, I would describe it as smart money. So when we say smart money, these people, if this is your first business, then really your experience is one. Whereas these angels and VCs, they could have invested in 100 businesses. So their experience is 100. So they've seen what works well, they've seen what hasn't, they've seen failures, and they've learned from that, and they want to be able to share that experience, and it's hugely valuable. So don't be shy in learning from them and accepting their experience. So smart money is a big benefit. Another big benefit is the gravitas or the credibility that it gives to your company. Because to get their investment, you will have had to go through due diligence, and because these angels and VCs, and particularly I think this applies more to VCs because the VC might have the brand, because they've done their due diligence and they have that experience, really when they've invested in you, that's their stamp of approval saying, I believe in this company, I think it's going to be hugely successful and make us a lot of money. So that does give you that credibility, and that can help with getting more customers as well, and certainly getting more funding in the future. So that gravitas and that credibility. Next, in terms of another benefit for both of them, is the networks they provide and the contacts and the ability to open doors. And particularly if you're a B2B business and you really only need 3 big customers in your first year, you just need a Tesco and a Sainsbury's. If an investor can introduce you to the head of purchasing, then that is a huge win for you, and that will just be the difference between you making it in your first year and not. So the ability to open doors is huge. So now just touching on some of the disadvantages. In terms of, again, venture capital and angels, some of the disadvantages, well, firstly, they might not have the exact same vision as you for your company. They might love the technology, they might love what you've done so far, but they might want to take it in a slightly different direction. Now, this can be a real challenge for entrepreneurs and founders to accept, because this is your baby, this is your heart and your soul, and you've worked on it for several years. You don't just want to change direction suddenly, but what I would just emphasize is that listen to them, understand where they're coming from, hear their experience, and try and come to an agreement. But bear this in mind before you accept the money, because you have to, whoever you accept it from, your angels, your VCs, you have to be able to get along well with them. You have to make sure you're on the same page from the beginning so there are no surprises later down the line, and be prepared for the fact that if they want to take it in a different direction, particularly if they're a VC and they've taken a lot of control of your company, they could have the power to do that. So really think about who you get into bed with before you take that investment. So that's direction. The next one is even harder to stomach. If they have a lot of control again, so probably more towards the VCs than the angels, but if they don't think you're performing as CEO, for example, as the way you should, they can replace you. They can get a new CEO. Now that is incredibly hard for some entrepreneurs to hear, because again, this is your company, you've built this, it's your idea, it's your baby, so how come somebody can fire you from your own business? I think it's very, very hard to accept that one. But the truth is, you might have been absolutely brilliant at starting your company and getting that initial growth. But perhaps when it gets to the scale stage, and perhaps if it's going to need international growth, perhaps that's not in your experience and that's not your skill set. Maybe not. So just think about it. But also remember, if you are replaced, that doesn't mean they've taken your company. You still have your ownership of your company, whether it's 20% by this stage or you still have maybe 40%, but just be aware that you could be replaced, so be open-minded about that. The final thing I'd say is a disadvantage is that a lot of angels and VCs put pressure on an early exit. I often hear them saying they want exit within 3 to 5 years, and I think that's really tough for entrepreneurs. It's very quick. But you have to be prepared for that, and if the right price comes along, if somebody comes along and wants to buy your company for a fantastic price, then you might be very happy with that. But be aware that those angels and VCs will be looking for a healthy early exit, because essentially until then their money is tied up in your enterprise, and they want to see their return on investment for a start, and then they also want to reinvest it elsewhere. So that's why they'll have a lot of pressure on that, and that might not be aligned with your own wishes. So those are some of the key differences between VCs and angels. Just want to touch briefly now on crowdfunding. Crowdfunding is really something that's come up in the last 8 years. It's not that old relatively. Crowdcube, I believe, was the first in the UK that was founded in 2011. Crowdfunding means that we're getting money, getting investment from the crowd, so from the people, from anyone. And they invested into a startup that has promoted themselves on one of these crowdfunding platforms. So I'm not a huge fan of crowdfunding. I don't think it supports the right risk management processes, and I don't think it's a good thing that there's no due diligence and there's no price negotiation. I don't think the investors are empowered to really find out enough about the company, to get to know the team, to really understand what their return on investment will be. And so that's why I'm not a huge fan of crowdfunding. I think certainly for investors who are high net worth or sophisticated, they absolutely should be doing their due diligence and their price negotiation, so negotiating the valuation of the company. And certainly any investor I know would want to go through that process, and therefore wouldn't go through crowdfunding. However, that said, let's not be too harsh on crowdfunding. Let's think about when it is appropriate. So I do think certainly crowdfunding is very appropriate for charities, or a cause, something that people, the masses, can feel passionate about, get involved in, really understand the progress that is being made. So that, I think crowdfunding has been fantastic for that. And then there's another area that I think crowdfunding is good for. And this is if you have a product that goes directly to the consumer. So let's just use a hat, for example. So if you have a hat and you want to sell this directly to the consumer, I think crowdfunding can be a good thing for you on some occasions, because the crowdfunding campaign is also your marketing campaign. And the people that will invest in your crowdfunding campaign will be people who like your hat, who want your hat. And in return, you can provide the promise of the hat. You can provide a first edition of the hat. And so essentially what you're getting, you're marketing yourself, but then you're also getting your first base of customers. So you're proving your concept through the campaign, and then you're getting your first batch of customers to fund the manufacturing of your hat. So then you can get them out and make a little bit of a profit and be able to start producing more. So I think if you have a product that is really direct to the customer, and you want to do that marketing, and you want to be able to get that funding to be able to help with your manufacturing, then I think crowdfunding can work for you. But overall, if you're a serious investor, then you really want to be doing your due diligence and negotiation of the valuation of the company. So that's crowdfunding. And then finally, I just want to touch on convertible notes. Convertible notes are a little bit of an odd one. You might not have heard it before, but essentially it's financing through debt, and then that debt converts into equity at the next funding round. Convertible notes are used because it's considered quite a simple structure, and they're used when you're not sure of the valuation of a company. And it really takes the pressure off the entrepreneur and the investor to think through the valuation if they really haven't been able to agree on it. And it reduces the risk for the investor. So the investor likes it a lot, and some entrepreneurs like it too, because it's easier in some respects. But it's not perfect, otherwise everyone would do it. So what are some of the downsides? Well, because it converts to the next funding round, it means this investor gets the same rights as the future investors. And this might put off some future investors. Might not, but sometimes future investors don't like when someone's got a convertible note and they're getting the same benefits later down the line. And then also, if you've got a convertible note that's too large and then it converts disproportionately large in the next funding round, that can also cause some problems for you. So just think through whether it's right for you, and if you're really not sure of your valuation at all and you need that money, you need it quickly, and it's just the right thing for you and the right thing for the investor, then not a problem. But just think through how that will affect your next funding round. So there we have it. Those are the brief overview of the types of funding. And if you want any more information and you've got any questions, then please do let me know. Either comment below or join inn.global, and you can private message me or live chat with me. Thanks so much. Bye.